Well, welcome once again to this DHANDHA series, and we have a special company once again with us, Cyient DLM. I think this is one of the IP which a lot of people in the market has been waiting for. Omkara again, this is Varinder Bansal. I have Shiva with me. He's the senior research analyst here with us, and we have the entire team of Cyient DLM joining us. It's a privilege, gentlemen, all of you to be with us. Krishna sir, of course, who is the chairman and the non-executive director. Rajendra sir, who is the managing director. And Anthony, who is in Paris but based out of US, and he's the CEO and the business head for Cyient DLM.
Nice to meet you.
Thank you very much, and thanks for this opportunity this afternoon.
Our honor. And before we start, one big disclaimer that Varinder Bansal or Omkara Capital has nothing to do commercially with these gentlemen or even Cyient DLM or Cyient as a company. This is only educative series what we do in order to make sure that people understand about the company. And second disclaimer, we, Omkara, and me personally are investors in Cyient Limited, which is the parent company for this company. And we are very happy shareholders and sitting on the company as long-term investors.
Thank you.
Thank you, sir. So, sir, we always say that when we start about this kind of a discussion, we always say there are 3 Ps. The first P is the promoter, second is the product, and then is the price. So, we will come to the product later. First I want to focus on the promoters. So, small confusion in the market, okay? Which is like, please tell us the difference between Cyient and Cyient DLM. Second question which everyone asks me is that if I'm a shareholder of Cyient Limited, do I get shares of Cyient DLM or not? Or even in the IPO, if I have to subscribe, do I have a special quota, which means that, I'm a shareholder of Cyient, do I get anything that? Please help us to understand, those things first.
So I can take that, and I'll just give you a little bit of history and how things evolved, because I think that will put into perspective sort of both the companies. But for those of you who know, Cyient is a technology services company. We do various things within the company around technology for products and networks, as we call it. But essentially, one of the important elements of our business is the work that we do on engineering services. That is, wherever there is a product, we help our customers design that product. And design could be mechanical engineering, electronics, embedded software. The way to understand it is, if you look at a cell phone, we help them design the mechanics, maybe not cell phone per se, but I'm just using that as an example. But, all the what's outside, which is the mechanics, what's inside, which is the electronics, and what runs the cell phone, which is the embedded software. So that's, you then extrapolate it into some of the bigger products like aerospace, rail, and so on and so forth. So that's been Cyient's core competence for a long time. For almost 32 years, we've been in this business. Now, about 5 or 6 years ago, what we realized is when we design something that gets manufactured, or typically it gets manufactured. Now, if you look at the industries that we work in on the design side, our core competence and our value proposition is we do very well in safety critical industries, right? If you look at something like aerospace, where we do a lot of business, aerospace works towards 99.99999 times 9 is the safety level that we work towards, and that's the design capability. So it's a very rigorous, intensive design activity that we've been doing. So we brought the same, we thought that the value proposition is, since our customers are anyway manufacturing after we design, the value proposition is we bring the same rigor, we bring the same intensity, the same process to manufacturing as we did to design. And therefore, our customers benefit because they get they know Cyient, they know the reputation of Cyient, and they can leverage on that. So that's how the whole manufacturing business came to Cyient. We acquired an entity, we created new capacity, etc., etc. But basically, within Cyient, on the engineering services division of Cyient, there was another add-on which was Cyient DLM, which was also doing the manufacturing. Now, therefore, in a simplistic manner, the difference between Cyient is on the software technology engineering side. Cyient DLM is on the manufacturing hardware side. And if I may just conclude that, I'll say, we see significant opportunities for manufacturing right now, both because of what's happening in the macro sense. with more electronics being used, China +1, India becoming a very viable market, but also specifically to where we bring additional capability, which is the fact that our credibility, our design processes, the fact that we understand the product from engineering, not just from manufacturing, etc. So this business will grow, and this business will grow at a much faster pace than Cyient, the engineering business grows. Now, the challenge it has created is obviously the economics of manufacturing are very different from economics of services. So as the DLM business grows, or as the manufacturing business grows, the overall economics of Cyient, which is the reality is Cyient is a publicly listed technology IT company. So there's a certain expectations on margin, there's a certain expectations on cash flow, which will get impacted significantly. So the reason why we're doing the IPO today, or we're doing the IPO now, is because it gives the manufacturing business its own capital and capital structure that it can grow on without necessarily penalizing the economics, if I may, of the listed IT company. Therefore, segueing into the second part of your question, that while as a Cyient shareholder, one would also have the same, or would have a proportional equity in Cyient DLM, because Cyient will continue to own 70% of Cyient DLM, or in that ballpark, with obviously depends on what the final numbers are, but about 2/3 of Cyient DLM will be owned by Cyient, and therefore the Cyient shareholders will still participate in the upside, and will participate in a significant manner in the upside of Cyient DLM from Cyient being a shareholder of Cyient.
If I'm a shareholder, do I get shares of Cyient DLM or not?
Not right now. Right now, it's only fresh capital that is being issued, because we want to really fund the growth of this business. But as I'll say, Cyient still owns 2/3, so you'll benefit. You won't get shares, but you'll benefit. Let me put it that way.
Any special quota in the IPO for the existing shareholders of Cyient?
We could not accommodate that. There's been a lot of demand, and we just had to make some choices, and this was one thing that we had to make.
I'll come on the growth, I'll come on challenges and everything, but I was just thinking of getting small procedures outside. Please tell us the organizational structure, okay? You, of course, you are at the helm of Cyient. You are also now the chairman and, chairman for Cyient DLM. In terms of the management bandwidth, how does it change, and how does it change, and especially in the last 6-7 years, how much time you have been building this management strength for DLM? And what does DLM stands for, sorry?
Okay. Let me answer the second part first. DLM design-led manufacturing. As you know, there's a lot of companies that do manufacturing already, and a lot of Indian companies that do manufacturing. But our differentiation comes from the fact that we come starting from design. So we understand the intent behind the product because of our design heritage. So design-led manufacturing means that we do design first and then manufacturing. Of course, not everything works that way. Like I said, it's still a small proportion, but we believe that's the ultimate value proposition that we bring to the table. That is, we understand design better than other companies, and therefore we're able to apply the design principles to manufacturing and therefore make a difference. That's what DLM stands for. In terms of just the management bandwidth, if I may answer, we took a conscious call about a year ago that both companies need to be run independently. Like I articulated, the economics are different, but the opportunities are huge. Therefore, we need to enable that. So Cyient has its own management structure. Karthikeyan Natarajan is the CEO, and the entire leadership team, of course, reports to him. He's responsible for the P&L. Similarly, in Cyient DLM, Anthony Montalbano, Anthony is here, and Anthony is the CEO. And Anthony has the P&L responsibility of the entire DLM operations. Rajendra Velagapudi is the managing director, and he also has the fiduciary responsibility for Cyient DLM. But all the business operations report to Anthony. So between Anthony and Karthik, we have enough bandwidth to run both organizations independently. And my mandate and my role is to make sure two things, right? One is from from a governance perspective, and we take a lot of pride in the fact that, governance has really got us this far, and that's something that we will not compromise under any circumstance. So I will make sure that we bring the same levels of governance, the same levels of or the same values, and so on, but also make sure that there's a focus on strategy, right? I mean, Anthony will spend a lot of time on making sure that the execution is on pace, but I will support him by making sure that we also take a bit of a longer term view on strategy, because the growth potential in this business is very, very large. And similarly on the services business also, I support Karthik primarily from a strategy perspective and execution of strategy, while all the business, of course, on all the operations directly report to Karthik.
You seem to be more in love with DLM than Cyient, sir.
This is a DLM call, so I do have to be in love, more love with DLM than Cyient. If it was a Cyient call, maybe you would have said this.
We are shareholders of Cyient, so we have to be biased. Okay.
But I think, sorry, I'll just say it, on a more serious note on that. I think that the opportunity is here and now, and we've made all the hard investments, and it's the right time for us to leverage on those investments. So I just want to assure you that I will make sure that both organizations are run for the potential that they have, and I'm very proud that we've two fantastic leaders at the helm, but equally importantly, a really strong management team behind it. So I'm not worried about operations. I'm more worried about what happens next, because again, like I said, the next is even more exciting in both organizations.
So one last question of the organization: is there an ESOP policy in place?
Yeah, absolutely. There's an ESOP policy in place in both organizations, and I think we've also requested shareholders for a permission or an approval for a new ESOP policy. But there is an ESOP policy which is primarily driven by shares are issued at par. It's driven more by time, but there's also an RSU policy where shares are issued at face value. And that's to convert some of the variable pay into an upside.
Percentage equity the employees might own in DLM.
Sorry?
How much percentage of equity might employees will own in this?
It's 5%. The first stock option plan has about 2.5% has been allocated already, 2.5 to 3%, I believe, and we'll allocate the rest at the next point. But also, I'll say the vesting schedule for the plan is based on performance, not just on time. So there's a performance threshold where the first tranche matures, and the performance threshold for the second tranche.
Lovely. So thank you so much, Anthony. On the first P side, which is the promoters. Second thing, sir, what is happening in this EMS? Why is this such a sexy word these days? Keynes, Sharma, Avalon, DLM. These are the kind of companies coming here. Okay, should I wait, sir? Krishna, sir, you
please go ahead.
Yeah.
Oh, we can't hear you, sir.
I think he lost his audio, but I think I can maybe take that question.
Yeah. So I'll complete my question. So what is, if I see...
Sorry, I was saying, I think anyway, Anthony should answer the question. I'm just going to look for a power cord. That's what I was saying.
Okay. So I was seeing your numbers, from 2014 to 2020, it's all flat, okay? I think 400 or 500 crores, flattish. But the last 1 or 2 years, I think suddenly the world has waken up. We have woken up in terms of what is happening to this sexy word of EMS. And if one more thing, if you can explain me, if for a normal investor to understand how is DLM different from your competitors, if they are your competitors like Sharma, Keynes, and Avalon.
Yeah, no, absolutely. And let me take just a couple minutes to kind of focus on the areas on where Cyient DLM is different, and also where we engage in the EMS space. And EMS is electronics manufacturing services from an industry perspective. And so, we are focused on 3 main sectors of that business, of that industry. So that's air and defense, medical and industrial, all low volume, high mix, safety critical, mission critical. So, this is a huge industry. This is a $3 trillion a year industry. And our focus in these very high quality segments leads to a much higher value service offerings that our clients demand, right? When you have products going into aircraft or in medical devices or these types of applications, the quality process, the way material is sourced, the way suppliers are brought up, the way factories are certified, it's a much different type of business compared to what you might find in consumer electronics. So this high value service offering is the core of our business. Our ability to support these applications in low volume, high mix is the way we run our factories. And it's the service level that our clients expect from us. And what is unique for a company of our size, right? These EMS companies on a global scale tend to be quite large, right? Even $1 billion company a year in revenues is actually can be relatively small in this industry. So, even though we are at a very high growth phase of our business that we foresee for many years, we still are quite small relative to the industry. And what's unique, though, is our clients. Even though we operate at the revenue that we do, our clients are really multinational industry leaders, right? We tend to have a similar client portfolio that you might compare to someone like a Celestica or a Plexus or a Sanmina, right? And these are more of the much larger multi-billion-dollar EMS OEMs that one would find. Yes, there are more regional India-based EMS providers that we're often compared to, but in our business, in the areas that we focus, we actually don't run into them so often, right? We usually tend to run into the larger multinationals, and again, that's due to the clients that we serve and the type of offerings. Because again, we don't do consumer, we don't do automotive, we don't do some of these other some of these other businesses that are not in the same value sector that we play in. So that is a fundamental difference, is our client base in that regard.
So the difference between Cyient DLM and other peers will be mostly which sectors you cater to, right?
Yeah, we are very focused. Correct. So it's very common. You look at some of the regional, providers. They might focus on 7 industries. Right. Yes, they might say they also do aero or defense, but if you double click, you might find that their level of penetration is far different. Right. So you walk through our factory and you see the products coming through our factories, you'll see only mission critical, safety critical products. Right. You're not going to see consumer products running in the same factory. And, this in a way lends a lot of confidence to our clients, right? When they're out trying to qualify a supplier for a high quality product that's going into a safety critical application, going through our factories, seeing those types of products with those types of logos, gives confidence in our quality and systems. And again, we've been doing this for 22 years in India, right? So this is also not new to us. We have a deep history in this regard. So again, the sector we play in, and then again, the multinational clients. We don't have a very large number of logos. Our logos are actually relatively smaller in count, but they are actually very significant in potential, right? Any one of these clients, I don't think there's any one of these where we make up more than 1% of their spend.
Yeah. So we see, you have Honeywell, Thales, Small BO, ABB, BL, as your critical clients. So, sorry. One question, because can you also explain that how many, say, manufacturing units you have, what is the kind of capacity you have? We understand, but it's important for a lot of viewers to understand that, that if I understand your business, to be honest, I'm just thinking that, is there a difference in terms of the process, what a company like DLM takes or some other companies take? Like, what is your moat? Moat means like, you have a technology,
edge you lay down while manufacturing,
or people or engineers who work in your factory. Because most of the people we talk to, like Kane, Sirma, and all these guys, they seem to be doing the same thing apart from the sector focus.
Right. Yeah, it's actually, so I think to answer the latter part of the question, right, I'll get back to the factories here in a minute. If you're to really say, hey, what's truly differentiated as far as operationally what we provide to our clients, right? So we've qualified, hey, this is a sector we play in. Okay, that's understood. But now how do we do it? Do we make circuit boards, or do we do these processes in a different, more unique way? What I would highlight is what is the biggest differentiator really is kind of how we got to where we are today, which is really based on our engineering capability. So when you look at Cyient engineering, having 7,000 design engineers available to us in manufacturing creates tremendous value we can bring to our clients that other manufacturers simply can't, right? So as an example, if a product is already in manufacturing, there might be supply chain constraints or challenges associated that come up over time. We can leverage our design engineers to come in and help source alternative components to assist with that supply chain. This is something we have in-house. It's part of our family. This is within our DNA. And these same products that we're making for our clients, there might be spins of these products for different regions, product updates. So we can start to engage in the design of these derivative products and next generation products for our clients, and start to not only do the design, but also have impact on the bill of material and supply chain. Because most of the industry in manufacturing, most of the EMS providers rely on their clients to give them the cost of bill of material designs already done. And it is also important to double click on what it means when a manufacturer says they have design capability. Okay, because there's design and engineering associated with manufacturing, and then there's design engineering associated with product development. And these are very different types of engineering capability, right? So, and it's really unprecedented in the EMS industry to have the design engagement that we have. And I'm talking in the industry, I'm not talking our size, I'm talking the largest multi-billion-dollar clients do not have anywhere close to the level of design capability that we have as being associated with Cyient. And so this is really what we can bring to our clients. This is probably by far our biggest differentiator. And that also can translate into cost reduction on other generation products. Also, there's a trend where the industry is going to what's called build to spec instead of build to print, right? So when you do build to spec work, the client comes to you and says, "Hey, we don't want you to just manufacture something we've designed. We'd like you to can you do the design and manufacturing?" So that then engages us in deeper, larger contracts, and that's becoming a bigger part of the dialogue today.
Understood. Can you help us with the plant's capacity?
Yeah. Oh, yes, absolutely. So today, we have what I'll call two main operations in India, providing the broad PCBA and box build type of manufacturing. That's in Hyderabad and in Mysore. And then we also have a third operation in Bangalore, which is really more of a much smaller machining operation where we do some precision mechanicals for some of our clients. But so the two main sites, though, again, Hyderabad and Mysore. Mysore has a long history. This is part of Rang Sons that was acquired. And then the Hyderabad facility is a relatively new greenfield construction. This was built right before COVID, right by the airport, world-class facility where has the same capabilities where we can support these exact same segments. And we have this targeted, where some of our larger clients can come in and help utilize that. So this footprint in India will carry us for at least the next 3 years, if not longer. And that's even considering, the growth that we are anticipating.
Got it. Sir, if I'm not wrong, my last question, sorry. Our capacity utilization of both the plants put together will be around 30%, right?
Correct.
Which means we have recently done capex, at least what I can see from the Hyderabad facility, because their capacity utilization is very low at 7.5%. I'm just
somewhere around 9%. Yes, I think it's just below 10% in Hyderabad. We're actually getting more business in there. But correct, that site does have capacity that we can utilize.
Which means that you can easily grow, your sales by 3 times, without putting in additional capex.
Absolutely, and it's actually interesting, just in a recent client meeting, the client was asking me, looking for some assurances on how, hey, we have a lot of business coming your way. We're concerned about, can you really scale, right? And I found it to be a very interesting concern because as far as, capacity, equipment, and talent, these are all non-issues for us, right? I think really the only thing that really comes in is the ability for our clients to move through their design and product execution process, and then also there are some supply chain aspects that come into play, right? So, but again, the timelines we're talking about, the sectors we play are actually, they're relatively what I call low beta sectors. So meaning they're not so volatile. So what this means is when a client says, hey, can you scale? They're not talking about, hey, can you have a ton of product running for me in 3 months? They're saying, hey, we're gonna ramp this product, in 12 months. Will you be able to do so? And in our sector, that's a very long timeline, right? So so we have we have some the luxury of being able to plan. We don't have consumer products which are highly volatile, right? If economy starts to weaken, even automotive is another example. If there's a concern, and demand can fluctuate, it can quickly translate into what the factories see. But in our sectors, industries we serve, medical, aero and defense, industrial, it's a little different, much different cycle.
Yeah, Cyient has always been more, dependent or focused on the aerospace, even if I take Cyient as a company, parent company, I don't know, maybe Mr. Krishna can take this or, Rajendra sir. Sir, it's a very interesting business, right? Your block is what, 120 crores block? With the current capacity, you might do around, say, 1,400, 1,500 crores of sales. With the current margins, and which I think you have been talking about of increasing the margins, you can do almost 100 crores profit going ahead if margins go to 15%. Your asset turns in this business is like 15, 16 times. And even if you have to increase the capacity, as Anthony is saying, if you get more and more clients, your capex need is not very high in this kind of a business, right? Like, can you help us to explain the economics of the business? Because it's like, put less money, and if you have clients over a period, you can generate.
Really, as your order book scales up, there is more revenue visibility which comes.
And your ROCs can shoot up.
Yeah, absolutely. I think in a nutshell, absolutely. I mean, if you look at the point that Anthony made, we'll have to have some incremental capex because there might be some bottleneck machines and some additional capability around mechanical machining, plastics, what have you. But the opportunity to scale up that business is for that reason itself is quite significant, right? Because just today, if you look at the capacity utilization being 1/3, that means we can do 3 times the revenue without very much more capex. And also the other thing is, if you look at our gross margins are quite stable. Actually, even increased a little bit last year. Now we've made a number of investments, and much of that, if you look at the gap between gross margin and say net margin, for most companies will not be more than 4-5%. In our case, that's almost 12%. And much of it is just the investments. So as scale comes, that absorption, because I can very confidently say that as scale comes, we don't need to add, any more leadership for sure. Yeah, we'll need to add salespeople, we'll need to add program managers, but that's all anyway marginal cost, which the marginal profit will more than make up for. So my point being, you're absolutely right. There is a very, very significant opportunity right now, and we see the runway to actually that growth, which will further skew, for lack of a better word, Cyient's economics, and that's the reason why we're listing this business separately.
So I guess in the Hyderabad facility right now we have 2 SMT lines.
That's correct. Yeah.
So how many more lines can we go up to, and say, like, what is the cost of putting up one more line, and how much can we generate over that line?
Yeah, so I think
we can go ahead.
No, go ahead, Rajendra, you can take that. Go ahead.
No. So yeah, I think so. We can place more SMT machines in Hyderabad. So close to another 8 to 10 machines, we can easily place it. We have the space available for the SMT lines. There is not an issue there. Right? And we said about the cost of the SMT line, probably around 7 to 8 crores is what each one of the SMT
What kind of revenue can we generate over each line, if you can break that down?
That depends upon the type of product what we manufacture and the part of components what goes on that and what is the value of the board. It all depends on that. So it will be varying from $5 to $15 million. So it's very difficult to just put a number there.
And so
Yeah.
I think, see, as we said, we are more focused towards the aerospace business. But as you mentioned, over the last couple of years, we have not seen a lot of revenue growth, say, from 2014 to 2020. So how are we, trying to pull more wallet share in the other industries, say medical, say railways, which we are already there, and, be less dependent on aerospace and remove the cyclicality in the business? So, like right now we have great news coming in from the Paris Air Show, and that is why, we see a lot of visibility in terms of revenue from the aerospace segment.
That's why please.
Yeah. So, when you look at Cyient DLM, right, specifically to the manufacturing business. So today, aerospace is making up about 20% of our overall revenue.
Right.
Okay. So, and defense is actually a larger percentage share. It's making up about 37%. This is due to some contracts we have running for the next couple of years. We have medical, which is currently 16%, and then we have industrial, which is about another 25%. Okay, so we actually have a pretty I would say we're kind we're heavy on defense, but we're relatively balanced on aero, medical, and industrial. Now aerospace is our fastest growing, right? We anticipate, based on what we see in our funnel, if I was to look out a couple of years, I would expect aerospace to start to make up a greater share of our portfolio than what you see today. I would expect medical to maybe increase to about 1/4 of our business today. And that's based on investments we're making in go-to-market, and then also in capability in that regard, and what we see in the funnel. And then industrial is a very broad category, right? But this is an area where we have expertise. We actually have some large clients in that area, and our pipeline there is strong as well. So we these sectors all actually generate similar returns for us. So we feel that this is going to be relatively well balanced. There'll always be the aero and defense bias to our business, but again, I still think that's going to be balanced nicely against medical and industrial.
Sir, is there a seasonality in the business? Like, we always are told that the first half is generally weak, or the first quarter is generally weak. Is there any seasonality in the business?
There does tend to be, right? So now when you look at the industries, right? The life cycle, the seasonality is not like a holiday shopping consumer type seasonality at all. It's very much longer term. But what we see in seasonality, we actually see it more from our clients and how they place orders, right? So we have seen, and I see this within the industry as well. There can be what I'd call a first half would be a bit softer than second half, and then even if you look at our projections, we've weighted it that way as well, right? We have a little bit greater in second half versus first half, and so I'd call it a mild seasonality just from that aspect of it.
So your top 5 clients constitutes around 70% of your revenue.
The top 10 clients is 90%.
But one day Honeywell or Thales or ABB says, hey, I will do my EMS on my own. I will not pay you 15%, right? They can go backward integrated.
Correct.
Is there a risk? I know, I've heard Mr. Krishna in a lot of interviews saying, that is not the risk, but certainly that comes on everyone's mind, because large chunk comes from few customers. What happens there?
Yeah, so there's always the risk that a client or industry could change its approach. But I think an important thing to look at, especially in these sectors, is you have to look at the long-term trends, right? So these clients that we list have very long relationships, right? So I think, for example, Honeywell was mentioned. I think we have a roughly a 17-year relationship with them. The products that we're making for these clients, again, these are products that have very long lifespans. And one thing that's very unique about this industry is, in the sector that we play, is that it's very uncommon to lose business that you are currently manufacturing to a competitor, right? So a competitor if a competitor come in and say, hey, we'll make that product today and we'll give you a 10% discount, it doesn't happen. It doesn't move. The flip side is it's also difficult for us to win business that's not new business, right? So it's uncommon for us to get business that's in manufacturing getting shifted to our factory. So the business is very sticky because it's not, price is important, but it's not as important as quality, process, history, and all of that. So yes, long term, a client might say, hey, we're going to start insourcing, but that's not something they do overnight. That's something that would take years. And this also introduces a unique aspect to the sectors that we play in, is that, even though we've had such significant growth, it's still a very high barrier industry for someone to come into. So if someone wants to open up a site where we are in India and start providing electronics that's going to go on an aircraft, that is like a 3-year window at minimum to get that up and going, right? You have to build the site, you have to get the site certified, and then you need the anchor clients that's going to have confidence to bring these types of products into that site, right? So again, it's not that we are immune to competition. We'll always have to be competitive, but we will have significant runway relative to other sectors to react to these.
Have we lost any big clients in the last 6-7 years?
I can't answer that. Rajendra, can you speak to any examples?
You're on mute, Mr. Rajendra.
Okay, so no, so we have not lost any of the major big clients. In fact, we ourselves have decided probably in the last, I think you asked a question earlier, why our revenue growth was not there initially. Yes. So that's where I think we just moved out some of the low margin customers. Okay. So that was the reason where we have backfilled all that with the high margin customers. But otherwise, we never lost any of the customer because of the price or because of the quality. So we never lost.
Sir, yeah. Order book it was I think 1,200 crores in March 2020. It suddenly jumped to 2,500 crores, around 2,500 crores in 1 year. What happened?
Yeah.
What happened suddenly? And this is executable over how long? Because sudden jump of doubling the order book, aisa kya ho gaya, sir? What suddenly happened?
Yeah. So go ahead. Yeah. Please go ahead.
So a lot of this, a lot of this order book, this is based off firm purchase orders, right? And this has really been in products that have been in work with Cyient for some time, right? So it's not like we just went in the last few months and booked a bunch of business and won this, right? These are programs we've been working with the same logos and clients that you see that's making up a good portion of our revenue. And also, if you I think to maybe help a investor or someone understand our business on the path we've gone on over the last few years, the last few years there's really been a tremendous focus on the bottom line of the business. Okay, so if you looked at our profitability and our business mix, about 4 years back, the margins were much lower. We had a greater mix of product. And so that has now really evolved, right? That's now grown to the bottom line profitability where you see today into the double digits. We did have some type of consumer product that was, though it was good for cash and inventory churns, it was actually dilutive in terms of margins. And so we've exited some of that business and focused here on the core. And so this has really driven, the mix and type of product that we have today. And this focus. And so now focusing on this, that's where you're seeing the profitability come in. And now you're seeing the top line starting to translate, right? So the bottom line we've delivered on, and that's what we plan to continue to deliver on. That's the new baseline. And part of this journey, the last couple of years, we've been focused on, okay, we got the bottom line up. Now let's scale with these top clients. And now you're seeing that in the order book. And then it's also, we also see it in our funnel, right? So we have a funnel that's not been, that's a funnel's a funnel. It's in work. So, we're very we're very happy that that'll continue to give us the outlook that we need for this business.
So we're just talking about the order book. So I think we're doing some projects for Honeywell Anthem as a program.
Correct.
So I think it's a very big deal, which is executable over a longer period.
Correct.
So just talk about it. What are we going to do there? And my second question is, sir, just on the product side, how many patents have we filed globally? How many IPs do we have? And how much time does it really take to transform a product, say, for example, from prototyping to really going into the client?
Yeah, got it. So in terms of Anthem, what I can speak to here is relative to what we've disclosed in the public, and where this is, it's really an industry leading deal, right? This was about a $250 million, TCV deal, I believe over 15 years, right? So if you just take a step back and think about this for a minute, for a company of our size, to secure a deal like this really is a true testament to what it means to be part of Cyient, to our capabilities that we have, and to, really the type of services and products we can deliver to our clients, right? And so that is, and our view is we don't view this as a one-off type of opportunity, right? We see this as what I would call an example of the strategy we want to execute going forward. We're not going to be adding 5 logos a quarter, 10 logos a quarter, right? You may see that many logos in a year. But so for us, it's not about adding a lot of logos. It's about aligning with the right industry leaders, and we will be announcing logos. But again, it's going to be in the same caliber. It's going to be industry leading OEMs, multinationals, where we can engage in these types of programs. So that's a little bit about Anthem. Specifically, that's for some of the product itself is for it's called Urban Air Mobility. It's a next generation cockpit electronics that they're going into these systems. So this is for some of their next generation products. So it's a very exciting program that we're engaged with them on. Regarding the patents and IP piece, I'm going to ask Rajendra to think about that answer while I answer the other third question. When you talk about the product development aspects of it, right? So, from a pure manufacturing perspective, in our segment, if a client has a design that is done and they want to ramp it up to manufacturing, a big part of that tends to be supply chain related. Are the components ready? When will they be ready? And all of that. Once the supply chain piece is addressed, ramping up for manufacturing is a pretty quick process. Usually it can be done within 1 quarter, 30 days is fast, maybe 60 to 90 days is kind of a good time frame. And again, that's once the design is done. Now, if a client is saying, hey, we want to do a design and manufacturing, how long will that take? So if we start a design process, it depends on what type of product we're designing. Is this one simple board or is this a complete system? We're working on one program with a strategic client right now where we've been working for a year and a half on a design, right? And this is something that we are going to, try and secure into manufacturing, and this will be a very long multi-year manufacturing program. So again, there's the design phase and then the manufacturing ramp-up phase. And then as far as patents and IP, Rajendra, do you have some details on what we can share in that regard?
Yeah, I think so. Basically, patents is predominantly on the design side. So where we have a lot of patents that have been filed from the Cyient Limited, which have been granted. And we also have done joint patents along with our customers, because the final IP also, whatever we do, while we're doing the designs, the patent, the IP belongs to the customers there. So that's why we jointly went ahead and submitted the patent applications with our engineer names and with the customer engineer names. So we have several of those patents, which runs more than 100 plus. But coming to the Cyient DLM, so we have not, we don't have any of the patents listed on the Cyient DLM name. Okay? Because it is basically on the process side, what we do on the manufacturing. So that will be our core, which we will be keeping internally with us. So that is our IP there. but we have not gone for the paid yet.
My two last questions, bookkeeping questions, okay? One, is Anthem part of the current order book or is it separate?
It is only
No, it is-
5% of what we have today in the order book, what you see right now. Otherwise, the rest of the thing is there, the TCV, the total contract value.
Lovely. And second bookkeeping question, sir, why are the inventory days so high for us?
So
You want-
yeah, inventory days can be a factor of the type of business we're engaging with our client, right? So there's a couple aspects. So this is one area that we've actually brought down considerably, over the last 18 months. But it's also a factor of some of the supply constraints that have been in the market, right? So what's happened now is that the supply chain is, and speaking with our top clients and also from our outlook, the sentiment is relatively positive on the supply chain, right? Much more positive. Now, that being said, sentiment is positive, meaning we don't expect shortages or some of the broad-based issues that have been hitting the industry over the last couple of years. But that being said, in order securing components, there are two aspects. It does take some of the lead times are longer, so you have to procure over orders over a longer period of time, and then there also is some inflation impact that's happening as well, right? And so it's kind of hard to tell if that's a permanent thing or if that'll restabilize. So those are kind of some of the items hitting there. But the supply chain, as far as inventory churn and all of that, we have a pretty aggressive path to actually bring that down. Same thing with conversion to cash flow, and that'll also impact ROCE. So this is an area that it's going to be longer in this sector. And in the sectors we play, low volume, high mix. If you're in a consumer sector, even though the margins are far low, you can actually use cash better and churn inventory quicker. But that's the nature of consumer product. But the trade-off is you have much lower profit.
Krishna sir, one question to you, if I can ask you, sir. Why are you doing this IPO? You are sitting on cash, investments, your balance sheet is healthy. You already have order book, and Anthem is a big, order which is in sight. You don't need huge capex, to execute these orders. You said 33% capacity utilization only. Considering if you do the growth, what you are envisaging of 1,500 crore sales, 100 crores profit, the cash flows will be enough to even push for more capex going ahead. And looking at the kind of valuations some of these EMS companies are getting, you will get 40-50 times, right, on the profits you will make. Wasn't it a better idea to just be as a unlisted entity and maybe once you grow to 100 plus crores, then do an IPO?
No, that's a good question, and obviously that's something that we've pondered quite a bit. See, the problem is if you look at Cyient and Cyient's listing as a technology services company, there are certain expectations that you as our investors have, right, on margin, on capital deployment, on predictability, which is another reality, I will say, just because it's not necessarily seasonality, but there is definitely an element of predictability. So as this business starts to ramp up, and we will see some very, very strong ramp up in this business, as this business starts to ramp up and it becomes a bigger and bigger proportion of Cyient's revenues, the economics of how Cyient will look like, when you say an IT services company or a technology services company, you expect a margin. I mean, forget anybody else. I would expect a margin of, at least 16 to 17%, at least in that range at an EBIT level for a mid-cap company, forget for a large company like a TCS. So as this business grows, that's starting to drag quite a bit on the overall services or the overall Cyient number, because, the margin here will only be 8, 9, 10% is what we anticipate in a medium term steady state, not more than that. So as this business, so one is, I think the good news definitely is that there's a lot of potential for growth, but that potential for growth will restrict some of the or will be restricted because of some of the constraints that we in Cyient right? In the parent would put on it. Just as an example, right? This business is also it should be measured on ROE. How much, or ROC, depending on the metric, but how much turns can you produce, how much cash can you produce? But the problem is, if we start to take that view, science economics, which typically a services business gets measured on EBIT margin, will get damaged. And we've actually let go a lot of business, which we, as an independent entity, we could have potentially done, because good ROE, good net margin, because there's a lot of the advances cover a lot of the cost, etc. But we just had to let go. So to your question, we considered that, is now the time, or do we wait? We thought just where the opportunity set is, we will get to that 100 crores number, not in a very distant future, right? We'll get there very, very quickly. So might as well do it now and give it the capital that is required for growth. Or maybe more than capital, I'll say the flexibility that Anthony and his leadership team need for growth.
I can see that you have been meeting a lot of investors, ROCs, ROEs, EBIT, and everything, very fluid.
No, but I think that's enough. But I think that's an important metric, right? Because that's really the, now that I can also step back a little bit and take a more holistic view, it is how efficiently are you deploying capital? Because as an investor, that's the, you have many choices, and you want a company that efficiently deploys your capital. Of course, safely, that is there, but efficiently is ultimately what the game is, right?
No, I agree, sir. Thank you, sir. My questions are over. Okay.
Sure. So last couple of questions. I think we are raising 700 crores, out of which a large chunk is going for the working capital needs. A certain part of debt repayment is happening. So the debt repayment is happening to the promoter company, or is it happening to the banks? Or from?
It's all third-party debt, because the proceeds of the IPO can't pay the or the promoter can't get paid for debt from the proceeds of the IPO. That's one. Second thing is, again, we still own 70%, or we will continue to own 70%. We're very confident, so I'm not in any hurry to collect my money, so to speak. Anthony will pay that back from operations very, very quickly. But the idea is, Cyient is still, we're very, very committed to this business, so we'll continue with that debt.
Yeah. And sir, I think we are going to spend 70 crores on inorganic, basically acquisitions in the DLM business. So what are we planning over there? Are we in talks with any company, or what are we really doing with that 70 crores?
Yeah, so, I think that is a part that is actually carved out by SEBI guidelines on what can be accounted for. But what I can share is, that the inorganic part of the business is actually an important part of our strategy. Okay, because, what is unique to us is our clients, where the number of clients we have are mostly Western clients. Okay, so these are companies headquartered in Europe, headquartered in USA, and then in these sectors, they actually have a lot of business where they could use additional skills and capabilities closer to their location. So as we look at potential inorganic aspects, there's three areas that we prioritize. The least of the three, the lowest priority is capacity. Right? We have capacity today in India, so we're not going to go and do an M&A for someone that's doing similar services that we could be doing today in our operations. So the number one thing that we value is capability. Right? So we're looking at clients that expand or build on the capabilities that we have, and that can include things like service, aftermarket services. It could mean cable wire harness type business. It could mean semiconductor type manufacturing. There's a lot of different sectors that we can add these capabilities that our existing clients and the clients in our funnel would take advantage of. So capabilities is first and foremost, and then the second item that we're going to value is that geographic footprint and proximity. So a very attractive target could be a company that is in these locations that I referenced, which could include, Mexico, US, Eastern Europe. They might have operations there, and then they might have these additional capabilities that we're looking for. There's been a lot of questions like, hey, you guys are only focused on these three sectors. Are you going to look at automotive? Are you going to look at consumer? And so, our point of view right now is we're in the most high value sectors there are. There's no question some of these other ones provide tremendous growth potential as well. But right now, for the scale where we are in a $3 trillion a year industry,
Yes.
we have tremendous runway, and we're going to focus on our core. Right now we've made a very conscious effort to say, hey, we're not going to do 7 industries. We're going to focus on 3 because that's where the expertise is.
No, wonderful. I think that completes the last question, which there is no overlap of clients of Cyient and Cyient DLM, right? There is no related party transactions between both the companies.
No, we share. So about 20% of our business today in Cyient DLM has started with Cyient Engineering, Cyient Limited. Right. So, it's a good number, right? So again, it's 20%, that's about 1/5 of our business. But again, 80% of the business we have today, we've earned purely on our capabilities as a, leading manufacturer.
And there is no money Cyient DLM has to pay to the promoters, right? Just
No. Only there is that debt that is still there, but outside of that, there is no further.
That's how much, sir?
That's about 200 crores, 200 some crores of debt is there.
So Cyient DLM will pay from this IP only, right?
No, not from
No. That's an existing. Yeah.
Going ahead, they will repay.
Exactly. And just to qualify that, I'll say, there's no related party transaction. See, even when there is a common customer, the contract is typically different. So there is enough independence. So it does not, obviously we're going to leverage each other because that's the whole, or we're going to leverage both the companies. But there isn't that, in that sense, there's no direct dependency.
Lovely, sir. A beautiful company. I think you are at the right time, at the right place in India, with so much happening in this EMS space. We wish nothing but all the best to, all of you, please, gentlemen. And please do take care of Cyient as well.
That is the primary entity still. So don't worry about Cyient.
No, we really enjoyed heartedly interacting with you and learning from you. Thanks for being so candid, so open. If there are any questions from your side, sir, now we are available.
No, thank you very much. Thanks for your time.
Thank you. Very nice to meet you.
Thank you. Right. Bye-bye.
Thank you, Rajendraji, Krishnaji, and Anthony.
Thank you.